Hi everyone, and welcome back to the channel for my latest portfolio update. So just like my last update, I have made several changes to strengthen and consolidate my portfolio to fewer holdings. So let's start off with the stocks I sold. So the first stock that I sold, because it actually went higher than my average, so we managed to sell this at a slight gain, was Smart Center's Real Estate Investment Trust. And the reason that I wanted to sell this was I reevaluated the business, and looking at the stock, it has retraced a little bit to the $25 range. It seems to be trading at near its historical averages at 12.3x its average. So it looks like I sold it a little bit above its historical average. And the main reason why I sold it was just a lack of growth. I do think that I do want a higher return in my portfolio. And, getting a 7% yield is nice, but I would like some dividend growth. And if not dividend growth, at least some capital appreciation. But as you can see here, they have not increased the distribution since 2019. And they really can't because their payout ratio is extremely high, usually well above the 90 range, which is too high because it doesn't leave the business a lot of room to reinvest to get a higher return and grow the dividend in the future. And that reflects in the financials as well. We can see the FFO per share has basically gone nowhere over the past 5 years. So you can't really expect them to grow the dividend or grow the funds from operation per share to get a capital appreciation from the stock. So because of that, I decided to sell. And it's true, they do have a lot of developments. They do have a lot of occupancy, but the results kind of speak for themselves as to why I sold this REIT, and I'm just going to be going forward with Granite REIT for my real estate exposure until I find a REIT that has a good combination of dividend growth and capital appreciation. But it's definitely not here. And I sold completely out of Scotiabank at a slight gain because they are not growing the dividend anymore, and my original thesis of them growing through Latin America frankly didn't work out. And the company has admitted that, and they have admitted that they have failed in this area, and they're going to focus more on Canadian and US banking. Again, payout ratio kind of high, at least for the big six banks, and it doesn't leave them as much room to reinvest for growth as the other banks. It may work out, but I would rather put my money into VDY. Partially sold it for that reason. I'd rather have an ETF for my bank since this was not a good pick. It may turn out to be a good pick in the future, but it's not one I want to specifically have as a single stock because I just don't know where it's going due to the way it's been managed. Maybe it'll turn around, who knows, but for now I would rather sell it, get a slight gain on it, and invest it elsewhere in the portfolio. I also sold out of TD Bank recently at a minor gain, and it really feels like I just dodged a bullet, as they not only have to pay a $3 billion fine for their recent money laundering fiasco, they will also have an asset cap on the US banking part of the business, which will highly impact the potential growth rate of this business, as it shuts the door on growth through acquisition. The stock has fallen, and rightfully so, after this terrible news. I invested the proceeds of the sale into shares of H Yield to boost my US exposure in my portfolio and replace the dividend income I received from these two banks that I sold. I bought a position in VDY as a new ETF, as it contains all big six Canadian banks, major insurance companies, and energy companies in Canada, pays a monthly distribution that has a very nice dividend CAGR. I also benefit from having less portfolio management to do, as I won't have to decide which Canadian bank I want to invest in, as this fund contains them all. And the last stock I sold was CP Rail. I do have plans to restart this position at a later time, but I found a new opportunity that I liked better. It will provide me an asymmetric return. And I want to build a position in this company while I believe the stock is trading at a very cheap valuation, so I needed to sell a position to raise the cash to fund the purchase. That company is Hims and Hers Health, stock ticker HIMS. I purchased 60 shares of this telehealth company that also provides prescription medication, which they send to your home through the mail. I took a look at other companies in the telehealth industry, and I noticed that HIMS was trading at a forward PE ratio of about 45. That may sound high, but not when you realize that HIMS has grown its business at over 50% per year over the last 3 years. Other competitors in this space have little to no growth or have the disadvantage of offering telehealth, but requiring their subscribers to physically go to a pharmacy to pick up medication. What HIMS provides is cheap generic drugs that are cheaper to buy out of pocket than going through the expensive insurance industry and pharmacy system, as you have to pay a markup to several middlemen before you get a medication you need. They also help people seeking healthcare, as many people experience long wait times to have to go through insurance or don't even have a family doctor. They built the business by acquiring pharmaceutical clinics that can produce the drugs for them and pass that savings on to members. They also use customer data to provide customized care. If you're allergic to something, they can create a custom compound or mix different medications to lower potential side effects and risks. The fundamentals of the business are also excellent. They have zero current liabilities and a strong balance sheet combined with growing free cash flow. The best part about this free cash flow is that the company currently has about a 10% free cash flow margin, and they expect that in the future they will have a 20 to 30% margin potentially. They also continue to expand their product offerings from sexual health, hair loss, anxiety, and depression medications, and now they're expanding into the market of weight loss at a much more affordable price. As products like Ozempic could cost upwards of $1,000 a month, HIMS can offer this for less than $200 a month. The exciting thing about this is nearly all of their current revenue is not from weight loss products, just the natural growth of their already established business. So there's so much more growth ahead for this business, and it's nice to back a business that helps people save on medications they need, as the US healthcare system is extremely expensive and complicated, with the insurance industry inflating the prices of medicine to unaffordable levels. And it also gives me some healthcare exposure, which is a sector that is really lacking in Canada. You really do have to go to the US market to get that exposure in your portfolio because, I mean, let's face it, the US is probably the best place in the world to invest for healthcare since they have all the advancements. And if you're enjoying the video, please do leave a like and subscribe to the channel so you never miss one of my updates. And the portfolio is sitting at all-time highs. It's at $44,456. Now at the buys in my TFSA, I purchased 2 more shares of ATD, going up to 27 total shares. And this company is facing a lot of downward pressure and selling because they're actively trying to buy 7-Eleven, and they have recently upped their bid to $47 billion to try to buy it. So we'll see if this deal actually ends up happening. I think that it would be a great purchase for ATD, just as long as they don't massively overpay for the business. I do think they can optimize it and run 7-Eleven better than 7-Eleven can run themselves, because they have not been doing a great job of it. And the numbers really do tell the story of how ATD is a much better operator of convenience stores, and 7-Eleven just is not great at it. I also purchased 5 more shares of EQ Bank. So this is the only individual bank stock that I hold right now, and that's because it's a very small market cap. It's a digital-only bank in Canada, and they do have the goal to grow their dividend by 20 to 25% annually for the foreseeable future. So very, very exciting holding, and I do think that there's a chance for a lot of capital appreciation, and it kind of fits the theme of what I want my portfolio to do, which is to have very high dividend growth so that in 10 years, 20 years, the dividend income will be very high, but also the total return will be good as well, because if you start with a low yield stock, then it has a lot more money to reinvest in itself to grow at higher rates. And we can see that with, companies like Dollarama and Brookfield doing extremely well. I mean, Brookfield especially pays a pretty low yield, and they're very good at reinvesting capital into themselves, and Dollarama does the same, which is why I like to hold these types of low dividend yield, high growth stocks in my portfolio. And with Granite REIT, I purchased a quarter of a share of Granite REIT, going up to 29.76. It's the only REIT that I have in my TFSA. I do hold Vici in my RRSP. So for me to hold a real estate investment trust, it needs to pay me a decent yield, but I also want it to have a good dividend growth as well, and just generally growing the funds from operation, which is going to drive the stock price higher. So that's what I'm looking for to reach, just a total return, but nice monthly income along the way. And then HIMS and HERS is the new position, 60 shares in this. I do hope that the price stays stable because this is not a full position yet. I want to make this about a 5% position. Right now it's sitting at 3.3%. So hopefully the stock doesn't go up too much. In fact, I'd prefer that it would fall. I can't really be in control of it, so I don't want to have a situation where, you know, it's like Palantir where I bought some shares of it. I bought, you know, about half as many shares as I wanted to, and then the stock has just raced up to be my best performing position because I've only held this for about 5.5 months and it's already up 76%. So I don't want that to happen again with HIMS, which is why I acted fast. I made a swing for it in a decent position, so if it does race up, you know, at least I got a decent amount of shares in. So hopefully it stays at these levels for a bit. I bought 101 shares of HTA going up to 192 shares. So this is paying me a lot of dividend income every single month. Gives me capital appreciation because it just has 20 very high margin, very profitable tech companies with no debt. So it has outperformed the S&P 500 since its inception, and I think it should continue to do so in the future. For H Yield, I purchased 197 shares, going up to 446, and this holding basically pays me almost $64 a month in income. So it is my largest individual holding, but it is just an ETF that holds a lot of different funds in the US market. It is a little bit overweight right now, but that's fine. I plan to have it be about a 10% holding in my portfolio. It's sitting at about 14% right now, but I'm going to build out other positions and gradually get that in line to the level that I want. It just allowed me to sell out of my individual Canadian banks and free up the capital to invest elsewhere without sacrificing that passive income in my portfolio, which we're going to see at the end of the video. So please do stay tuned for that because it is a really good increase over my previous update. And I purchased 2 shares of TELUS, just reinvesting my dividend back into this holding. This one's not doing so great. It is the worst investment in my portfolio so far, but with the interest rate cuts coming ahead and their decrease of capital expenditures, this could prove to be a pretty well-performing stock. I don't plan on selling this one, mainly because, you know, we're down in the position. I'm not in a rush to sell it. I only really sold the other positions that I had because they broke even, and, you know, my love for them has kind of soured a little bit for various different reasons. And for Visa, I purchased 1.16 shares of it, basically being at the position size I want. It's very close to 5%. If it does, you know, dip a little bit, I'll keep buying a little bit more. But right now, I would say that building out my HIMS position is my main priority in my portfolio. So assuming the price doesn't skyrocket anytime soon, I do want to continue building this and make it a real focus and make it a full position. And then the new stock that I bought was VDY. So this is this Canadian dividend ETF that grows its distribution, pays monthly, and really fits what I want to do in the portfolio. And it does allow me to not have individual big 6 bank holdings. I do hold EQ Bank, but that is a very small, you know, $4 billion bank that has a lot more room to grow in Canada. And they are a digital-only bank, and younger people are more open, definitely more open to a digital-only bank than an older customer, you know, which may take some convincing, you know, that you don't need branches to visit for your bank because you are paying to maintain that infrastructure with high fees and maybe not the best service. And with the dividends earned in the portfolio has earned $3,436 in dividends since inception. The annual dividends have increased massively from $18.36 per month to $19.99 per month. So very close to hitting my $2,000 per year annual dividends goal. The monthly average has gone from $153 to $166 per month. And the daily average, it has gone from $5.03 a day to $5.48 per day in dividend income. And for the days of freedom, we've gone from 30 days of expenses covered by the annual dividends in my portfolio to 32.7. So a little bit over a month to an extra almost 3 days. So we're working on getting our second month of expenses covered just from the portfolio. So very nice to see that progress. And the hourly wage, if my portfolio was to work a 40-hour work week for me, it made it 88 cents per hour. It's gone to 96 cents per hour. And if we look at the year over year for 2024, I have earned more dividends than 2023. So we've earned 1324.06. 1106 was in 2023, where we're basically doubling 2022. And there's still more dividends to earn in October, and we still have November and December. So very nice to see that progress in the portfolio. So thank you all so much for watching, and let me know in the comments below which stocks you're buying in the month of October.